stop thinking your money in the bank is an asset. According to the fine print of the Dodd-Frank Act, once you deposit it, you are technically an unsecured creditor. Let that sink in. That means, legally, your money is no longer your money. It becomes the bank's liability. And in a crisis, liabilities can be frozen, converted, or even used to save the bank itself. Now, before you panic, stay with me, because what I'm about to show you is not theory. It's already happened before, and the warning signs in April 2026 are flashing again right now. Behind the scenes of the financial system, something dangerous is happening. Banks are facing a liquidity crunch. Here's what that means in simple terms. Banks don't actually keep your money sitting in a vault. They lend it out, invest it, and rely on constant inflows to stay stable. But in 2026, three major pressures are hitting at once. Rising interest rates have crushed bond values. Commercial real estate loans are going bad. And large depositors are quietly pulling money out. This creates a dangerous mismatch. Banks owe depositors cash, but their assets are locked in long-term, losing value. So when too many people want their money at once, the system starts to crack. And when that happens, governments and regulators have only two choices. Let's break this down. Clearly, bail out. This is what happened in 2008. The government steps in, prints money, and rescues the banks using taxpayer funds. Bail in. This is the new model. Instead of saving banks with public money, the bank saves itself. Using your deposits. Yes, your checking account, your savings account, your emergency fund. In a bail-in scenario, withdrawals can be restricted, deposits can be partially frozen, and in extreme cases, converted into bank shares, meaning you don't get your money back in cash. You get stock in a failing bank. Now here's the part most people miss. Banks don't announce a bail-in, they signal it. Here are three warning signs to watch right now. 1. Withdrawal restrictions. If your bank suddenly lowers ATM limits, delays large transfers, or adds processing times for withdrawals, that's not random. That's liquidity stress. 2. Changes in terms of service. This is critical. Banks quietly update their agreements. Look for phrases like temporary restrictions during market conditions, emergency stabilization measures, account access limitations. These are legal setups for control. 3. Sudden executive exits. When top bank executives start resigning without clear reasons, that's not coincidence. That's insiders stepping away before instability becomes public. Now, let's talk solutions. This is not about panic. This is about positioning. You don't need to move everything, but you should diversify where your money lives. Here are three strategic moves smart investors are making right now. 1. Physical gold. Gold is not tied to the banking system. No counterparty risk. No digital freeze. It's been a store of value for thousands of years, and in crises, it shines the most. 2. Credit unions. Unlike large commercial banks, credit unions are member-owned, typically take fewer risks, and often maintain stronger liquidity ratios. They're not immune, but they're generally more conservative. 3. Cold storage outside the banking system. This includes physical cash reserves, secure offline digital wallets, or assets held completely outside traditional banks. The key idea? Control. Because in a crisis, access matters more than numbers on a screen. Let me be clear, this is not about fear. This is about awareness. Most people will ignore these signals until it's too late. But now you know, your bank balance is not just savings, it's exposure. So ask yourself one question tonight. If access to your money was restricted tomorrow, would you be ready? Because, in 2026, the rules of banking have already changed. This content is for educational purposes only. It is not professional financial advice. Investing involves risk. Always do your own research.